Across the UK, it's been reported that homeowners may soon face a significant shift in how their properties are taxed. Following the decision not to raise income tax, reports now suggest that the government is turning to property wealth as a major source of revenue. Instead of increasing taxes on pay, spending, or businesses, it's being reported that ministers are exploring ways to raise money directly from people who own homes, particularly those in high-value properties. This marks one of the biggest potential changes in household taxation in years. Families who worked hard to buy and keep a home may now find themselves at the risk of higher bills, new levies, and charges that could follow them for decades. Reports indicate that the focus within the Treasury is shifting towards taxing the value of homes rather than raising headline rates of income tax, VAT, or national insurance. For millions of homeowners, this raises concerns about affordability, fairness, and the long-term stability of the housing market. The Chancellor is understood to be considering a mansion tax, which could include a £600 million surcharge on hundreds of thousands of high-value homes. The Treasury is preparing to use the existing council tax system to revalue 2.4 million of the most valuable properties across bands F, G, and H over the next few years, representing 1 in 10 English homes. But Miss Reeves will allow people to defer paying the new tax until they move house or after they die, amid concerns that asset-rich, cash-poor homeowners, especially pensioners, could be forced to sell their homes to cover the cost. According to ongoing reporting, one of the most significant changes under consideration is a large-scale revaluation of properties in England. It's being suggested that around 2.4 million homes in council tax bands F, G, and H could be reassessed. These are not only luxury properties or exclusive mansions. Many of these homes are ordinary family houses whose value has increased over decades because of market conditions, not because the homeowners themselves are wealthy. If this tax is introduced, it's expected to generate strong criticism and widespread pushback. The reason is simple. A policy affecting roughly 1 in 10 homes is not a marginal change. It's a major intervention in the housing system. Many of the properties that could be caught by this measure are not owned by high-income households, but by long-term residents whose homes have increased in value over time due to market conditions, not personal wealth. Some of these homeowners simply bought the right house at the right time, and over the years the value of the property has increased dramatically. For these homeowners, the idea of paying more tax simply for the luxury of living in their own home, the same home they've lived in for many years, will be viewed as unfair. People who worked for decades to pay off their mortgages may feel as though they're being charged again for something they already sacrificed to secure. This is why the proposal is considered particularly sensitive. It risks being seen not as a tax on luxury, but as a tax on ordinary families who happen to live in areas where property prices have risen. It is believed 1 in 10 homes in England currently designated band F or above for council tax will be revalued and could be under threat of an additional charge. While it's dubbed the mansion tax by Labour insiders, suggesting it'll only hit the wealthiest, it will affect a share of the 1.3 million middle-class families living in band F properties. The surcharge is expected to hit families living in London and the South East, where home values are higher. They could face annual surcharges of hundreds of pounds on top of bills which already average £3,293. If the reported plans go ahead, the revaluation could lead to higher annual council tax bills for hundreds of thousands of families. For some households, this may mean paying a few £100s more each year. For others, particularly those in the highest value bands, reports imply the increase could be much larger, potentially thousands of pounds annually. But beyond the financial mechanics, there's a deeper emotional weight to what's being proposed. For many families, a home is not a luxury asset. It's the place where they raised their children, built their memories, and invested decades of sacrifice to pay off a mortgage. That's why critics are warning that taxing people simply for the privilege of staying in their own home crosses a line. As one commentator put it, this begins to feel like paying the government a yearly fee just to live in the property you already own. And that's where the outrage truly begins. People who are asset rich but income poor, especially pensioners, fear being taxed on a house they can't afford to sell, while others worry about passing on a family home only to saddle their children with a debt they never created. The mere suggestion of a mansion tax has already caused some homeowners to say they will sit tight and avoid moving altogether, afraid that downsizing could trigger a tax bill large enough to force them out of the housing ladder entirely. The most controversial element being reported is the option for homeowners to defer these additional charges. People who cannot afford to pay the higher tax immediately, particularly pensioners or families living on fixed incomes, may be allowed to postpone payment until they move house or they pass away. The unpaid amount would then be recovered either when the property is sold or when it's transferred to the next generation. This effectively means that, according to reports, some families could face a tax bill at the point of inheritance. Combined with existing inheritance tax rates, this could create an additional financial burden at a time when families are already dealing with emotional and economic pressures. Critics have described this as a form of death-related tax emerging through the back door, since the charge may not appear until the owner dies. On Saturday night, Kemi Badenoch, the Conservative leader, said a mansion tax payable on death was another unjustified raid on pensioners who have done the right thing and worked hard their whole lives. Writing for The Telegraph, she said, "It is measures like this that don't just kill growth, but kill the forces of aspiration and hard work that help build our economy. No wonder so much wealth has already fled the country. No wonder so many are reconsidering whether the UK is the right place for them and their children." Sir Mel Stride, the Shadow Chancellor, said the plans amounted to a new death tax via the back door, while Richard Tice, the Deputy Reform UK leader, said Rachel Reeves promised last year to not come back with more tax rises. She lied. Experts believe that if the government goes ahead with taxing property wealth, they're unlikely to introduce a brand new mansion tax from scratch. Creating an entirely new tax system would be complicated, politically messy, and time-consuming. The far more realistic option, and the one economists expect, is that the government will simply use the existing council tax system and increase charges for higher value homes. On paper, ministers can argue that makes sense. After all, property values in the UK have risen dramatically since council tax bans were created in the early 1990s. Many homes that were once considered moderately priced are now worth far more, not because the owners are wealthy, but because the market changed around them. But once you look beneath the surface, the problems become more obvious. The biggest issue is the households who are asset rich but income poor. These are people, often pensioners, widows or long-term homeowners, who live in a house that has increased in value but do not have the income to pay higher taxes on it. They're being treated as wealthy on paper, even though their monthly finances are extremely tight. If the government tells them they must pay hundreds or even thousands more per year, they simply won't be able to. This is why the Treasury is reportedly considering allowing people to defer the extra tax until they move house or they die. But even that solution creates a fresh set of problems. If homeowners know they'll face a large tax bill the moment they sell their home, they'll be far less willing to move. Someone living alone in a large family house who might genuinely want to downsize and free up that property for a younger family may instead choose to stay put just to avoid triggering a massive bill. That freezes up housing stock, reduces mobility, and makes it harder for young families to find homes. In other words, a policy designed to raise money could end up discouraging people from moving, drying up supply, and creating more pressure in an already broken housing market. If homeowners know they'll face a large tax bill the moment they sell their home, they'll be far less willing to move. Someone living alone in a large family house who might genuinely want to downsize and free up that property for a younger family may instead choose to stay put to avoid triggering a massive bill. That freezes up housing stock, reduces mobility, and makes it even harder for younger families to find homes. In other words, a policy designed to raise money could end up discouraging people from moving, driving up supply and creating more pressure in an already broken housing market. Economists call this the unintended consequences problem. Politicians try to fix one issue but end up creating 3 new ones. But the concerns do not end there. Additional reporting suggests that the financial impact could be even greater once interest on deferred tax is factored in. Some reports also suggest that interest may be added to deferred payments. Economists have argued that deferred tax loses value over time due to inflation, and therefore interest may be applied to ensure the Treasury receives the equivalent value. If implemented, this would mean that families could inherit not only a home but also a substantial tax bill that's grown over several years. For example, if a homeowner defers payments for 10 years, the total amount owed could increase significantly once interest is applied. Family members may be confronted with a lump sum that is far larger than the original tax amount attributed to the property. In some cases, this could force them to sell the home to clear the debt. On the broader economic front, consumer confidence could also be affected. When homeowners feel financially insecure, they tend to reduce spending. This can slow economic growth at a time when the country is already facing financial challenges. Investors may also hesitate if they perceive the UK as becoming increasingly reliant on property-based taxation. Supporters of potential reforms argue that the current council tax system is outdated and disproportionately burdens lower valued homes. They claim that revaluation would create a fairer structure where high value properties contribute more. However, this argument assumes that rising property values reflect rising wealth, an assumption many homeowners dispute. For most families, a home is not a liquid asset. It can't be easily used to pay rising taxes. Its value may have increased due to external market conditions, but the owner's financial situation may remain unchanged. Treating a home like a primary source of tax revenue does not account for this reality. As Budget Day approaches, homeowners across the country are watching closely for confirmation of these reported measures. Many fear that additional changes may be introduced, adding more pressure to household finances. Questions remain about how much homeowners will be expected to contribute and whether these policies will genuinely help to address the country's financial challenges. What is clear from reports and public reaction is that a shift towards heavier taxation of property is underway. Whether these measures will be implemented exactly as described, adjusted, or expanded remains to be seen. In the end, the issue goes far beyond whether homeowners should pay a little more. The real danger lies in the unintended consequences that these proposals could unleash across the entire housing market. And in the UK, the housing market is not just another sector. It's one of the largest engines of economic growth, influencing everything from consumer spending to construction, investment, and household confidence. We already know that stamp duty suppresses the number of property transactions each year. Economists have repeatedly warned that it acts as a brake on mobility, discouraging people from moving, downsizing, or upsizing. Adding yet another tax burden, one that could impact 1 in 10 families, risks tightening that brake even further. If people choose not to move because doing so triggers a large deferred tax bill, the housing market slows. When the housing market slows, the wider economy feels it almost immediately. A sluggish market means fewer sales, fewer renovations, less construction, and lower spending on everything from furniture to legal services. Confidence falls, investment pauses, economic activity weakens. What begins as a targeted tax on high-value homes can easily become a nationwide drag on growth. If the government pushes ahead without fully understanding these ripple effects, the consequences could be far more damaging than the revenue they hope to raise.